this is our also forward rate, because the current spot rate is also our forward rate. Okay, here it is not mentioned. It is not mentioned here, but don't worry about that. I think I copied wrong. So this is also the current spot rate, and also they enter into the same amount of forward rate as well. So forward rate is 0.0020. Okay. So at the time of delivery, no matter is in the market, what it is the rate is 0.0023, but you will settle on forward rate. So the value of the position going to be, you enter into a buy. You will buy at what rate? This rate? No, you will buy at forward rate. You will buy at forward rate, and seller will be selling you at this rate, right? But this is NDF. Seller will not give you 100 million Chilean peso. Seller will send you the difference. So difference between forward rate and future spot rate. Future spot rate on 1st of July would be 0.0023. So the difference is 0.0003 multiplied by 100 million. Answer going to be $30,000. So rather sending you in your account 100 million pesos, the buyer will, or the seller will be sending you how much? So at the time of settlement, if the peso value increases to 0.0023, the value of the position of the NDF will be $200,000 and $230,000. Since the value of the NDF position is 30,000 higher than the agreement created, Jackson will receive the payment of 30,000 from the bank, and here bank is seller. All right. So recall that Jackson needs 100 million pesos. So Jackson will go to the market. It already planned that it has 200,000 for 100 million pesos, 100 million pesos, Chilean pesos on 1st of April. Jackson, from the Jackson pocket, $200,000 needed. Extra $30,000 is coming from bank. So since the peso's spot rate has increased, so Jackson will need to pay extra 30,000 more for the import than if it had paid for them on April. So same time, however, Jackson will receive a payment of 30,000 due to NDF. So Jackson will go to the market, purchase 100 million Chilean pesos, and extra 30,000 he will receive from the position of the contract, and you can hedge your exchange rate risk. So you don't have to pay from your own pocket $30,000. All right, the $30,000 is coming from seller, so your initial budget is not disturbed. All right, guys, you understand? Tara, Meena, Oliver, Tiffany,
Yep.
PD.
Yes.
Good. So if you understand that, now answer this question. So I'm going to give you 5 minutes time. So this is individual class participation. Take it as individual class participation. Everybody, take out the page, write down your name, and solve this question. Show your work, okay? Not just say, okay, A, B, or C, show your work. And then we'll do it together. So meanwhile, I'm pausing the video for 5 minutes. And after that, I would be resuming it. Okay, class. So the answer is, so let me just read the question here. Sorry about that. So let's read the question here. So the Gray Lawn Incorporation, based on Washington, exports products to German firms and will receive 200,000 euros in 3 months. On June 1st, the spot rate of the euro was 1.10 and the 3-month forward rate is 1.10. On June 1st, the Greyland negotiated a contract with the bank to sell. So they enter into a contract of sell forward. Time is equal to 3 months and forward rate is equal to 1.10, which is 1.10 dollar over euro, right? Yes, dollar over euro. So the spot rate of the euro on September 1st is 1.15. The Gray Lawn will receive how much? Since they enter into a contract, so no matter how much is the spot rate at the beginning and how much is the spot rate at the end or a future spot rate, you will be executing the transaction on forward rate. Answer going to be C, which is 200,000 multiplied by 1.1 to 20,000 euros. Dollars. Right, guys? Well done. So now currency futures market. So there is a small difference between forward and future, and that is similar to forward contracts in their obligations and to purchase and sell currency on a specified settlement in the date. The difference is that futures are more standardized, right? Which means the forward can be 400 million, one contract is 100 million, 50 million, 100,000, 10,000. It's a customized as required by the customers, right? For individual needs, for company needs, whatsoever. But if futures, it means they are standardized per contract. For example, one contract is for $100,000 if you are dealing with the dollar. So if you want to hedge your $500,000, how you can hedge it? You need to purchase 5 contracts. Enter into a buy 5 contracts. 5 contracts means you are entering into $500,000, right? Only one thing. So it offers more liquidity. For example, in some cases, if you only need $400,000 instead of $500,000, you can sell one contract, right? Because one contract will offer more liquidity for them. If something happens, if you planned that you will be receiving $500,000, but at the end you are receiving $400,000, so you can take offset position of only one contract rather than the whole contract, which is $500,000. So that is a more advantage of being in a future rather than in forward. So typically US based companies, typically based on US dollars, but they can also be in other currencies as well. We will see that. So they are normally traded on Chicago Mercantile Exchange. All right. So here we go. So one Australian dollar contract is 100,000 Australian dollars. If you need 3,000 Australian dollars, you will need to buy 3 contracts. If you have a contract for $250,000, can you complete that? Answer is no. So for that, either you need to buy 3 contracts or either you need to buy 2 contracts. But still, either here, if you buy 3 contracts, you have bought 50,000 Australian dollar extra, or here you are short of In two contract, you are short of 50,000 Australian dollar because these are standardized. The Brazilian real is in 100,000. British pound is 62,500. Canadian dollar is 100,000. Chinese yuan is 1 million. Czech koruna is 4 million. Euro is on 125,000. Similarly, you may see that the Swiss franc is 125,000. Right? South Africa rand is for 500,000. And Russian ruble is 2.5 million rubles. Mexican peso, 500,000. You see the Korean won, it is 125 million. Chinese yen, Japanese yen is also, Japanese yen is 12.5 million. Korean won is 125 million. So these are standardized. If you need 2 or 3 contracts, you can do that. It offers more liquidity, more standardized, more regulated, right? So trading futures can also be used for, the purposes, but in this case, firms or individuals can execute orders for currency contract by calling the brokerage firm. You can ask the middleman agent to execute transaction on your behalf. And how you do that? Through electronically trading platform. Mercantile stock exchange platform, you can use that in US or in your own country. You have your own stock exchange for currencies. You can also do that. These platforms serve as a broker. For them, you need to maintain some kind of balances, margins on that one. So currency future contracts are similar to forward contract in evaluation. Similar what we have done in forward, the same we can use that. The only thing is that in this case, this is more standardized, that's it. The currency future contracts are similar to forward in that they allow customers to lock in the rate at a specified currency, whether it is purchased or sold for a specified date in future. But here, the rate is called future rate, rather forward rate. So no matter if you enter into a contract, this is obligation. No matter what is the future spot rate, what is the current spot rate, that is no longer, no longer of importance to you. You will be dealing, or you will be dealt on the future rate. That's it. So what is the difference between forward and future? Like I tell, the delivery date is also standardized, and this is the forward is customized, future is standardized. For example, futures are only available for 30 days, 60 days, 90 days. But if you need 45 days, you can also go for forward contract. Delivery date is also customized, but here is also standardized. Participants here in forward, they can be banks, brokers, multinational, but here they can be bank, brokers, multinational, qualified public speculators, and all those stuff. So both participants are, exactly, not the same, but 90% same. Only is that in forward, public speculators are not involved. Like if I want to make a benefit, I can go to futures